If the IRS audited your trucking company tomorrow, would you be ready? For a lot of small fleets, the answer is no, and the penalties can be brutal. Today, I'll break down the top things the IRS looks for in trucking audits, the red flags that trigger them, and what you can do now to avoid costly mistakes later. Hi, I'm Mike Ritzema, the host of Driven for Success, a podcast to help small trucking company owners execute back office tasks much more easily and much more profitably. Before we get into audits, because I know everybody wants to hear about that, we have some breaking news from the IRS that affects trucking companies. The IRS, usually in the beginning, middle of September, as they did, announces the per diem rate that starts October 1 and goes for the next year. Well, this year, it's $80 coming up, same as last year. They didn't change it. They decided inflation doesn't affect truck drivers or something. I don't quite know how they get to their math, but that's where they got to. So if you were paying $80 before, you don't have to make any changes to your per diem policy for the coming year. If you're not paying per diem and you have drivers out overnight doing, they're over the road drivers, you really want to look into that. We've got podcast episodes about it, and there's things all over our website at truckingpayroll.com to show you how you can save money and put more money in your driver's pay. So keep that in mind, and it's still good for another year at $80 a day. Speaking of the IRS, we'll get into today's episode, which is what they're looking for when they audit small trucking companies. Well, we're going to start with why trucking gets audited more often than other people might. Trucking and construction both kind of have this deal where they have transactions that are different than most businesses. A manufacturing facility or a restaurant or a doctor's office has the same kind of things happen all the time. And trucking has very crazy swings up and down in revenue, up and down in expenses. As an example, and it's going to seem obvious to trucking people, but the IRS doesn't always pick up on this. Your fuel costs do crazy things based on the price of fuel. Your revenue does crazy things based on the price of fuel. If fuel skyrockets, your revenue is going to go up, which sounds good, but it's really all just going into the diesel tank. So the IRS will see their revenue went way up but it all went to fuel. Something must be going on. And we're like, yeah, fuel's more expensive. But things like that start to trigger what they would call irregularities, which brings you an audit. Another thing that can get you audited is trucking is known to have a lot of drivers getting paid 1099 that are not supposed to. Again, that's like construction, where there's just a lot of people getting 1099s. They're supposed to be getting W-2s. And that for the government is money being left on the table for them because they're not collecting what they feel like they should be collecting. And that's going to make them audit. And finally, just again, a lot of these are like construction, but it applies here too. Trucking ends up on the radar because a mistake can be a huge mistake. And because they really don't understand how it works, they're going to be a little more skeptical. So you really want to, you want to be prepared in the event it comes. Now, in the tease of this episode, I talked about if the IRS audited you tomorrow. The IRS generally doesn't do that. They don't generally say, hey, we're showing up tomorrow at 8 a.m., be ready. They'll give you a little more time than that. But you never know. It's the IRS. They kind of do what they do, right? So let's talk about some of the things they're going to look at. In the event they come in and audit you and you kind of get what I would call the full body cavity search audit, let's look at what they might investigate. The first thing is payroll tax compliance. They want to make sure that you're making your 941 and 940 deposits. For those who don't know, 941 deposits are the federal withholding and the FICA withheld from the employee's check, plus the FICA match, Social Security and Medicare match that the employer has to put in. And so the 941 form reconciles all those payments to what the actual wages and amounts due were. The 940 is federal unemployment tax. For most people, it's $42 a year if you pay at least $7,000 in wages to that person. There are some states that have a surcharge that I can go into another episode, but California and New York pay a little more. The Virgin Islands, U.S. Virgin Islands, pay a lot more. If you have a trucking company there, by the way, in the U.S. Virgin Islands, give me a call. I would love to come visit you and talk to you about what we do, even if you don't want to buy it, because I would like to make the trip down there and be compliant with all this audit stuff. So that's what the first thing they'll look at, and they'll look for late deposits or underreported wages. So you want to keep all your records tidy from your payroll service. If you use a payroll service, if you do it in-house, you want to keep your own records tidy. For all of you, no matter who you are, you should be able to, you're already registered for what's called EFTPS. It's how you make it's the Electronic Federal Tax Payment Service from the government. And so you're already registered for it if us or another payroll service is making tax deposits for you. And if you have employees, you're making tax deposits. So but you can go in there and you can look at your deposit history. So you can see the money's all there. And I recommend that you do that, especially if you use a payroll service or you have an employee that does it for you that you're not really watching, because you want to make sure those deposits get made. Because if they don't, they're coming to you. The IRS is coming to you to get that money. They're not going to, well, my payroll service said they paid it. They won't care. Or my payroll service was supposed to pay it. They're not going to care. They're going to want it from you because you are the taxpayer. So go to eftps.gov and you should be able to look all those things up. You might have to go get your password reset or something, but it's all there for you. And it's a great way to make sure things aren't going to be a problem. But again, like all audit things, it's always the problem from the past that you're dealing with now. So this is just an easy way to do it. Another thing the IRS may choose to look at is W-2 versus 1099. We talked about this in a previous podcast episode. However, it's something that they can look at. One of the things that would trigger that is if you issued a 1099 and a W-2 to the same person or payee in the same year, the same social security number in the same year. That is going to make them scratch their head and go, why are they getting a $20,000 1099 and a $40,000 W-2? Now, there are instances where that is legal. So as an example, let's say somebody who works for you as a W-2 employee also owns a side business where they clean offices, and you've decided to let them clean the office for a fee. The office cleaning fee could be 1099. They've provided their own supply. I mean, there's conditions to it, but if the employee provided their own supplies and did all their own and was able to do this work for other people, things like that, then you're probably okay. But if you're 1099ing them for half the year and W-2ing them for the half the year, you're kind of asking for an audit. Quick side pro tip on that: if you're going to fix this year, fix the whole year. If you decide, I'm recording this in late September, you decide, oh shoot, I should have been W-2 all year, fix the whole year. Don't just start October 1st paying W-2 to the same people. I mean, you should be paying W-2 to the same people, but you're going to have to go fix the beginning of the year too. So the IRS will look at, in a 1099 versus W-2 audit, they'll look at control and ownership and exclusivity. Exclusivity, you're always going to beat because it's a DOT requirement on the drivers, but ownership, who owns the truck, who's responsible for the maintenance of the truck. If the truck has the truck motor blows up, who's paying for it? Is the trucking company paying for it, or is the driver paying for it? Things like that. We have a great test for this on truckingpayroll.com. If you go to the trucking success tools in the menu, you'll see a W-2 versus 1099 evaluation. You just answer the questions. It's going to spit you out a score and tell you what it means. It's absolutely free. It's going to cost you your email address, and that's it. So I encourage you all to do that. I think it's a great tool. We've worked hard on these things to make them better for you because we want to help people stay out of these kinds of audits, right? So yeah, if they do end up reclassifying your 1099s into W-2s, you're going to have big problems. We don't want that. That's never good. So better to be out in front of it. Another thing they'll look at a little bit is per diem. I put it in here because we talk about per diem all the time, but the IRS doesn't really understand it. You're probably going to have to explain it to them, but that's okay. Use small words. They'll understand. But the most they're going to do with that is they're going to look at your records to make sure the driver was really gone on the run that had them be gone. If you've got a bill of lading, because you keep your bills, you don't keep your logs forever, thankfully, but you keep your bills of lading or whatever that shows that the driver picked up the load in Chicago, Illinois, and delivered the load in Denver, Colorado. Yeah, he gets a per diem day for that, or two, or whatever it takes him to do it, depending on the weather. So that's all you need to do is prove the driver went there, and you should be good. Now, the next thing that they'll look at is your record keeping and documentation, much like a DOT audit in a way where sometimes you're doing the right things but not showing your work and you get in trouble. This would be kind of the same thing. They'll want to look at your payroll journals, your expense journals, trip sheets, settlements, maybe some contracts, which will kind of go into the 1099 versus W-2 as well. The way to look at it is if it isn't documented, it didn't happen. It's innocent until proven guilty is true in a criminal court of law. In the IRS, not so much. There can be a whole bunch of side discussions about, is that a violation of self-incrimination, or a violation of the Fourth Amendment? Yeah, probably, but it's time after time the courts have held up that the IRS can do it. So you're kind of stuck on that. Uh, it just is the way it is. So my advice is digitize all that stuff. Digitize all your receipts. Put them in your TMS with a load if you can. A lot of TMSs will let you upload documents. I know Ascend TMS does. So you just put them there. Just keep yourself some records, and be able to be willing and able to prove what you put on your tax return as an expense. That will make your life a lot easier. The next thing they're going to look at, and this is going to be a problem for some people, hopefully not you, is owner compensation and what I will call fringe benefits, but they're really not fringe benefits. Fringe benefits, a lot of people think are things like retirement plans and health insurance, and yeah, those are fine. But the owner getting a boat, not so fine. I do some taxes sometimes, and I had a client who wanted to write off his boat. He owned his own business. It wasn't trucking. And I flat out told him there was no way. And he's like, but I took a customer on it. I'm like, congratulations. You can't deduct your 40,000, whatever. I don't remember how much the amount was, boat, because you took a customer or two on it. That is not nearly enough. And the IRS would tell you it's not reasonable and customary expenses for your business. He agreed with me. He's like, I got to take a shot. I'm like, yeah, okay, I guess that's one, but come on. But they're really going to look for personal expenses run through your business. They're going to look for, are you going to the grocery store and charging that to the business and it's really food? There is some coding in credit card things that say what you're buying versus if we have I'm in Grand Rapids, Michigan, Meijer, home of Meijer, they're kind of superstores like Super Walmart, if you're not familiar. And if you go to the gas station, it will come through as a different code. If you go to the store, so you can't just go, if that you're paying for your own gas through, trying to charge it as office supplies. Don't do that. Bad. IRS will figure it out on that and they will deny it, and then you'll be in trouble. So here's some of the patterns that trigger audits. And this is where we get in trouble. There's big swings in revenue and expense, not just the trajectory going up, but if it's like this, which you're going to have in trucking, like we talked about, because price of diesel goes up $1 a gallon, right? You're going to have a bunch more revenue and a bunch more fuel expense. Repeated penalties or a million amended returns. Amending a return is fine. Amending the return all the time or amending the same return multiple times starts to become an issue. Sometimes it's anonymous tips. If you make a driver mad, they could roll up on you and say, oh, I know he's doing this thing. And they could be completely lying. I'm not accusing you of doing anything that's incorrect. But the DOT audits get triggered the same way. I know a trucking company who had a disgruntled driver leave and called the DOT on him and said, these guys are cheating. And then they got a whole audit from it. It was terrible. So, and all the stuff they said wasn't true, but you still got to go prove it. There's also, the IRS has their own scoring system as well to determine if they should do audits. Now, they don't do as many audits as they used to, 20, 30 years ago. They just don't have the staff for it. And not every audit is like this. Sometimes the audit is very specific. They'll say, we question your fuel amount as a deduction because we don't know anything about trucking and we don't understand that trucks don't get 20 miles to the gallon. So we want to know why you spent so much on fuel as a percentage of your revenue. And you just got to be able to produce receipts, which could be your fuel card report, will be most of it. And then the whole thing goes away. And some of those are even done by mail or done by image download or whatever, email and things like that. So, but this is like for the full, they're coming in to really check you out audit, which I hope none of you ever have to experience. But you could. You just got to be mindful of it, and you should be prepared for it all the time, much like a DOT audit. If you get a notice of a DOT audit and then you're like, shoot, I got to fix all my driver records. Like, oh man, just do it just do it when the driver's there. Like do it at new hire orientation and make sure you have all the documents you need. Make sure you're keeping up on your med cards and things like that. There's lots of teaser reporting systems you can use to make sure that you're always staying up on that. If you need a suggestion, reach out to me and I can suggest some, but there's lots of ways to do it. Make sure the driver's license is not expired, things like that. That's the knucklehead stuff you just don't want to get caught up on because they probably are compliant. They have a valid driver's license, but you just didn't get a copy. It's the same way with IRS audits. You just want to make sure you have the things you need. One other thing they look at before we wrap this up is they look at meals. I'm not talking about per diem. I'm talking about meals that the owner does or that the office people do or whoever the executives do. It used to be that, okay, back in the day, in the early 80s, meals were 100% deductible, and so was entertainment. So taking a customer to a ball game was completely deductible. Then in the 80s, they shifted it down to only being 50% deductible for those things. And then in 2017, 2018, with the tax changes that happened then, they changed it again and said entertainment is not deductible. Meals still are to 50% deductible. But for the meals, you got to have some things on that receipt. You need to have, there's 5 things. I remember this from school way back in the day. Where it was, when it was, who was there, how much it cost, and what was discussed. So you can't just say, well, my buddy might want to be a truck driver someday, so I took him out to BW3 and we watched a football game and ordered a couple pitchers of beer and talked about whether he'd want to be a driver for 5 seconds. That's not going to be deductible. So you just be mindful of that. And that's the easy stuff too that they get you for, because that's where most people will try and sneak stuff through. So to recap, the IRS focuses on payroll tax, employee classification, per diem, records, and owner compensation. If you're worried about compliance, we can help you on the payroll side. We can help you set that up the right way to make sure that you're okay. If you're worried about the other audit things and you're worried about a tax return, we really don't do many of those anymore, but I can connect you with people who do, because I know trucking experts for tax, and they can help you make sure that you'd survive an audit. It's important, and so you should be running good books anyway, just your own books, to know if you're profitable or not. And so, but yeah, I'd be happy to set you up. I know a number of them, depending on who's the best fit for you for what your situation is. Reach out to me. You can comment wherever you find this. You can email me at askmike@truckingpayroll.com, and I'm happy to refer you. Go to our website. We have good trucking people to know. You can find people right there, and they can help you with these things as well. The next episode next week is going to be about payroll errors and how they cost you a lot more than you think they do. Can't wait to get into that with you. In the meantime, just keep on trucking, and we'll talk to you soon.